If you're only chasing revenue, it just leads to bad decisions. Believing that your job is to make other people believe in it. Where I'm looking at is Q1 and Q2 next year. You just get really good at identifying, where the problems are in the business.
Hello and welcome back to the Story Hero podcast. This week I'm joined by Richie Lennon, founder of Around Finance. Richie is probably located 300 meters down the road from me, but we don't have a proper camera set up here in where I'm based here this afternoon, so we have to do that remotely. But Richie, you're very, very welcome to the show. Delighted to have you on board. I'm really looking forward to getting into it today.
Likewise, Thomas, we've had interesting conversations every time we've met, and yeah, really looking forward to the chat that we're going to have today.
Absolutely. Richie, for the purpose of the audience, it'd be great for those who don't know you to maybe just give a quick level, maybe high level overview in terms of who you are, what you work on, and a little bit about Around Finance.
Oh, thank you very much. I suppose the kind of quick kind of summary is I'm an accountant by trade. I've owned and operated Around Finance for 10 years at this stage, going on 11 years. For much of that time, as I was building the practice, I would have supplemented my income by working with the local enterprise offices, working with Enterprise Ireland. I would have delivered a lot of the finance module and startup programs up and down the country. And in addition to that, I've been lucky enough to sit in the CFO seat in a local business here called Kinvara Skincare since 2017, 2018. And in addition to that, I've been involved with a number of different businesses in this CFO role, one being a firm called Alice PR in Dublin. And I've known Martina since she was a one-woman band on the laptop, and now they've got quite a number of people working for them and a big team in Dublin. And it was given that experience, and I kind of know from your own background as well that when you do a lot of this business consulting, whereby you're in these one-to-one sessions with businesses and you grind that out over 7, 8, 9 years, you just get really good at identifying, where the problems are in a business, and you've got this kind of cross-reference radar that's just ready to kind of really put your finger on what's happening. And about 3 years ago, I just rebranded the practice and I said, okay, well, let's try and find places that we can add value. And with that in mind, we renamed it to Around Finance. And the cohorts of clients we've been working with over the course of the last 4 or 5 years are either tech startups from my EI days, a lot of marketing agencies, and a lot of e-commerce and e-commerce businesses. Well, I kind of broaden the definition of it as people who sell product, whether it be online and offline. So there's a bit of B2B and B2C going on. At the moment, we're growing reasonably quickly. Every month that goes on, I'm sending out more proposals than the previous month and landing a lot of clients. So we're in this kind of recruitment and growing mode. So it's just a matter of trying to keep up with it. But I suppose the key thing about us is that a little bit different than your traditional accountants. The way I would suggest that we deliver our services is in 3 phases. Phase 1 is organize, phase 2 is analyze, and phase 3 is grow. And really what that means is we just get everything on Xero or QuickBooks or whatever we want to use. And the idea here is we sit with the business owner, get an understanding of their business, try and figure out what they're at, what we want to analyze and why are we measuring it, what's important, and where they want to go, which is the grow bit. And then for us, it's about engaging with clients to look forwards as opposed to constantly looking backwards to see what was the tax bill last year. And it's that kind of hands-on commercial approach that would come from my mentoring days, and we've applied as a service here in the practice that seems to be adding value to clients. And for us, when we're getting to know clients, when we're popping the hood and getting to understand their businesses intimately, it's that value-added stuff that's really fun to do as a profession and really fun to do for everybody else on the team. So I suppose that's it in a nutshell in terms of what we do. And yeah, I suppose it's given me an understanding of this e-commerce space from the heady days of pre-COVID and everything that's happened since. And I suppose that's when I started getting to talk to you about this kind of understanding of profit in an e-commerce environment.
100%. And I actually think it was one of the things that struck me when we initially spoke that, I'm speaking to loads of different accountants, but I think too many e-commerce businesses unfortunately have an accountant that isn't willing to get into the weeds and actually understand what's going on from a marketing perspective. The marketing is often the heaviest line of the entire P&L, and if the person who's kind of guiding you from a finance perspective isn't looking to, extend their own capabilities to help you at least navigate that conversation, they're inextricably linked really for any DTC business today. It's kind of putting you in a challenging position. You often outsource your marketing to an agency who are experts in marketing. But if you are outsourcing your accounting function, which, the large majority of SMEs will be. If that finance function can't at least understand what the marketing are doing and they're spending a hell of a lot of money, it's very, very difficult to get sound advice from the finance team or the accounting kind of team, as with the nature of yourself. So that was definitely one thing that kind of stuck out to me the first time we spoke, is that, you're obviously speaking with a lot of e-commerce brands, but you really, really understood a lot of what was going on within the ad accounts. Not that you're a marketer by any stretch of the imagination, but it's so important, I think, now more than ever, for finance team to be linked to marketing, and also for the marketing agency to at least have some understanding as to what the finance team is doing as well.
I completely agree, and as time's gone on, I've a bit of I spent many years with a confused looking kid sitting at the back of the schoolroom trying to raise his hand and ask, well, what do you mean by ROAS, and what do you mean by attribution, and what do you mean, and not getting straight answers. And it was just, you kind of spend enough time in the
There are no
space, and
straight answers.
but you can get to something which looks like, and I know this problem that you set out to solve in Store Hero was that let's try and understand profit at least. It shouldn't be difficult to understand profit before we start jumping into these kind of advertising engines and seeing things like attribution. So I think that was where we kind of first had a conversation. I was going, thank God I've actually met a marketeer who wants to talk about, I think, market efficiency ratios, which is just last month's marketing spend divided by last month's sales, and let's build from there and get an understanding of looking forwards again and forecasting and what we think our budgets need to be and so on.
Absolutely, 100%. So you've obviously worked with plenty of different SMEs throughout the country, of varying degrees of sizes in an e-commerce capacity, and obviously in other capacities too. Obviously, the customer acquisition costs for a lot of these brands, I'm sure your own clients know more than the rest of the clients that we're working with, they've gone north in the last couple of years. What are you seeing, like, we'll say, some of the best DTC brands that you're working with are doing from a finance perspective? Like, are they, even as a budgeting, forecasting exercises, are they looking at their businesses through different lenses? Or be interested in just to get your own feedback on that.
It's been really interesting, that lots of e-commerce brands have started picking up the phone to their accountant only really in the last couple of years, and in that pre-COVID space when, before poor old Mark Zuckerberg got dragged up for GDPR, and and there's a bunch of these headwinds that came into the space, big retailers coming online, kind of competing for AdWords, the growth of marketplaces. So we've got a lot of D2C brands that would have existed and just been making good money. Like, I suppose in this kind of pre-COVID world, if you've got margin and you've got sales, you don't really need to think about kind of
Just work.
cash flow management, and kind of you just pump the money into Facebook and you're getting such good ROAS that you just keep pumping it and the cash is building in the bank, and you don't really need to understand your business from a fundamental financial perspective. And what I would suggest is that what I'm starting to see in a lot of DC brands that are succeeding is that they're starting to understand the finance fundamentals in their business. And what it's actually doing is that it's still possible, obviously, to be highly successful online and have very
Yeah.
successful businesses, but it's sorting the wheat from the chaff. And what you're now seeing is that people are really starting to understand things that they didn't have to pay attention to previously in business. I used to say this when I was teaching classes, is that I used to have a client, and she sold artisan meats and to markets and different things like that. And she said, Richie, I don't know what this zero stuff is, but I can look at a pig and tell you how many sausages I'm going to get off him. And that kind of always stuck in my head. It's like, it's not that I'm trying to teach people debits and credits and kind of, the interaction between balance sheet and P&L, but there's some finance fundamentals that I think most DTC businesses should know. And I think in terms of what the good ones are doing, I think fundamentally they're looking at a management pack that's customized and is tailored to their business, and they're getting good input on a monthly basis and walking their business forward in quarterly sprints, or in EOS language, it's rocks, or whatever you want to call it. So the idea here is that we sit down, forecast for the year. There's a management pack that we look at monthly and say, are we on track, off track? Every 90 days, there's a deep dive, and we can adjust the forecast as necessary and say, okay, are we hitting what we thought we are going to hit? Do we need to revise? And it's back to this thing I said before, whereby we're looking forwards, not backwards, and managing the future as opposed to kind of always looking in a rearview mirror. I will say, and as a accountant's input, that a lot of the forecasts that I see that are built by marketeers and who are built by entrepreneurs be on the optimistic version of what they think the future is going to hold. And that's completely because marketeers are looking for sales and entrepreneurs are looking to success, and it's always tilting in this optimistic reality. And what I would suggest is that in terms of how I look at the world is my first uh, forecast that I built, I call it a baseline forecast. And really in kind of in going back to lean startup language, it's like your minimal viable forecast. So the question there that you're asking is, what is the minimum performance or what is the minimum that we need to achieve as a business over the course of the next 90 days so that we don't have to make decisions to start adjusting what we're doing? And if you can get back to something that looks like a baseline, then you know that if you're not hitting at least that baseline, you need to start adjusting. And you can have two forecasts, which might be amazing, which is you can have, okay, you've got this baseline. Okay, if we're not hitting 20 grand a month, let's adjust, or we're not hitting 50 grand a month, let's adjust. And you'd have this good forecast, which you can kind of go, okay, we're doing better than we expected, and you can make certain decisions in that way. And I think sometimes when I meet people initially is that they're managing the business on this slightly over optimistic forecast, which then they're not hitting on a monthly basis, and it's too late when you're looking back on a quarterly basis. So I think the first thing to do is try and get as close to reality in terms of when you're doing your forecasting. The next thing I'd say in terms of just in this space would be is that I think recently what we started looking at more closely is just good cash flow reporting. So, in a DTC business, there's not that much of a difference between your P&L forecast and your cash flow forecast. Essentially, the difference is going to be you've got COGS in your P&L and you've got to buy the inventory in your cash flow. So you've got this lumpiness that's in your business from a cash flow perspective that you need to manage carefully. So most of our e-commerce businesses, we now have a P&L which looks similar to what you've got in Store Hero, but we're also marrying that with a cash flow with a bunch of other metrics that we will customize for the business. And I think that's what good looks like from a DTC brand on a monthly, quarterly basis that I'm seeing at the
I
moment.
suppose, yeah, and that's one thing we run into with some brands as well, and that obviously, profit is not cash flow. You can
Yeah.
have a profitable business and ultimately run out of cash. Do you want to like just explain that to businesses and how people listening, I suppose, and how that could happen? Because just because you're profitable doesn't mean that you're heavy cash flow for heavy in cash flow or whatever you want to call it.
Well, this is it. I think in accountancy language we call it cash conversion cycles, and there's three pillars to your cash conversion cycle. There's debtors days, how long does it take me to get paid? There's creditors days, how long does it take me to pay other people? Then there's this other one, which is inventory days, which is how long does it take me to flip the stock, to get the profit out of the stock, to put it back into the bank account, to buy more stock, and so on. And I think in an e-commerce business or a direct consumer business, well, you don't have debtors days because somebody buys something on the website and goes straight
Yeah.
in, all good. And you don't have creditors days as such. Well, a lot of e-commerce businesses are actually just paying for the stuff up front. So really what you're looking at is what is your stock turnover? And if you want to measure that, if anybody's listening, just look at the current stock on hand that's in your balance sheet. How much are you carrying in terms of your stock, in terms of cost value? And ask yourself the question, well, how much was the average amount of stock that we're carrying over the course of the last 3 months? So, for example, if you started the period with 75 grand in stock and you ended the period with 100 grand in stock over a 2 month period divided by two, you're probably carrying something like 75,000 euros worth of stock. If your COGS is 15 grand a month, well, you're now carrying 5 months worth of stock. And what I would say to most people is that if you look at their balance sheet, often they'll have very little money in the bank account and then 75 grand or 100 grand or 150 grand worth of stock in there. And I think one of the areas that a lot of direct consumer entrepreneurs could look at is, well, what are we doing about this stock thing and how scientific are we getting about, number one, understanding how long is it taking to convert our stock into cash? And number two, is there anything we can do to reduce the reduce the amount of stock that's been tied up in cash? And there are things that you could do, and a lot of direct consumer brands have zero credit terms. So it's not that you're not even it's not even your so let's say for example, I'll go back to my previous example where you're carrying 75,000 euros worth of stock on hand and your average COGS is 15 grand a month. So it's taking you 5 months to sell through that stock. Okay, well the question would be then, is there anything you can do on the credit side to reduce that in terms of actually reducing the number of days that it's taking you to turn that stock into cash? And one of the things you could look at is trying to get some credit terms. And there's an awful lot of direct consumer brands out there with no credit terms. So that, for example, if you're buying from China, you're paying that money out, and God knows it's 30 days again on top of this stock turnover days before the stock gets into the warehouse in Ireland, and then you're probably 5 months from that day before you start turning it into cash. So what I would suggest to people is that in addition to looking at, all the P&L metrics that you should be looking at, and what you guys are doing in Store Hero is great, is to start understanding your cash conversion cycles inside your business. And there are things that you can look at in there. For example, well, people tend to like, how much stock do you actually need to carry? A lot of entrepreneurs carry, if you walk into a shop often, I used to, back in my kind of Leo days where I'd pick up a gig, you walk in and that's a bloody lot of stock in here. And yeah, I like the place full of stock, it's got a nice look to it. Man, this is madness, because it's just, it's like you've got a big pallet worth of cash in the warehouse that you're paying where insurance for and light and heat, and really the only value in that stock that's in the warehouse is how quick you can turn it over and get the profit out.
Yeah, no, that's great. So like, I mean, one thing we kind of run into with brands sometimes is that, there's you're trying to forecast profitability for a certain month, but then also you log in and you can see that they're heavily, as you said, really, really overstocked. And there definitely is months where it doesn't make sense to be as profitable as they could be because it's going to just limit the cash flow capabilities of the business. And there is instances where we just have aged stock that needs to go, and then we need
Yeah.
to put discounts in place or put incentives in place for customers to just sell through that. Yes, you might reduce your profit margin as a result, but cash flow is king to keep the business going, and at least the business will keep flowing as a result. Is there instances, or is there any guidance you'd have for brands listening? Is there any kind of barometers, ratios, whatever you want to call it, that you would say when you look at a business, you are heavily overstocked here?
I think that's just take your average stock on hand, divide it by COGS, and see how many months worth of stock that you're carrying. If you're carrying something like 5 months worth of stock, so okay, so a lot of DTC brands, there's a seasonality to it. So you're going to be loading up on stock coming into probably now in advance of kind of Black Friday, Cyber Monday, and all that. So it's okay to stock up at certain points of the year, but I think if one of the metrics you want to start looking at is just at your cash conversion cycle, which is for most D2C brands is average stock on hand divided by COGS. How much stock are we carrying? And you're trying to measure that across the course of a year, and ideally not have it really, really big in January, February, so you're not carrying too much stock. And in addition to that, I would say is just for those that aren't doing it at the moment, is just get really scientific about stock triggers. So the idea being having a run rate per SKU and a stock trigger per SKU, and then asking yourself the question like, well, do we need all these odd sizes, and how much are we buying? And just to get really scientific in that space, I would suggest would be the first place that I would recommend looking. Because what often happens is that you can have a P&L with sales, COGS, marketing, and contribution margins and profit, and no money in the bank to go and buy more stock to keep servicing the business. And now you're into lending and sources of finance and all that sort of thing, which I think as the headwinds I mentioned previously have started to blow that a little bit harder, this is the situation that a lot of DCC businesses I find are sitting in.
Yeah, it's one we're consistently running into for sure as well. Just before we kind of move off it, I suppose you mentioned different cash conversion cycles there. I know Gymshark famously like heavily grew their business based on this concept of a negative cash conversion cycle. Just curious to kind of get your thoughts on even miss an explainer for the audience here listening. What does a negative cash conversion cycle look like? Obviously, it's the Halicon, it's the gold standard. Not every brand can do that. And maybe explain the reasons as to why a new SME setting up today couldn't get those kind of terms to facilitate a negative cash conversion cycle.
So it's in those two spaces. If you just like, okay, B2B is different. It adds kind of, if you're not getting paid for 56 days, it's a different thing. But just in D2C, let's just take those two parts of the cash conversion cycle. So you've got your stock days, and then for the sake of argument, let's say 150 days or something like that. So 5 months by 30. And we'd say, okay, it's 150 days to try and switch this stock into cash. But how do you fix that? Well, actually, you try and reduce the cash conversion cycle somehow by not carrying as much. But let's say that's not an option for you. You need to carry a lot of stock. Well, how do you reduce it? It's by getting credit terms. So if you're plus 150 on the stock days and minus 150 on the credit days, then you're going to net out and if you could get to 151 on the credit terms, you're going to be selling something before you buy it, if you understand me. So if you can reach a point in time whereby you can reduce your stock on hand days to maybe 4 months, it's 120 days, and you could get credit terms, which would be, okay, we pay you a deposit, you guys put it on the boat, but we need some kind of credit terms. So if you had stock on hand days of 120 days to convert that stock into cash, but you weren't paying people to 121 days, you'd build cash in the business. there's an example. It's not the same example, but I had a client who was a B2B business, and the way he had it structured, so each container that was coming over could have been costing like 30 grand or something like that. But the way he would do it would be is he had a big B2B retailer that was buying from him, is that in order for them to trigger a sale, they would need to pay him 40% of a deposit. And in order for him to order stock from China, he would have to pay 35% of a deposit. So he was all so like the 40% comes in, he gets 35%, he's got 5% margin on the deposit, and then the balance there's a 65%, 70% thing landing, and he just always had the cash coming in. So the idea is, can you design your business whereby you're getting money from your customers before you're paying it to your suppliers? And that's what Gymshark were doing, because they had the muscle to turn around to their suppliers and say, listen, guys, we need credit terms. And if I was the accountant sitting there, I'd say 155 days or whatever, just give yourself breathing room. So what I would suggest to a lot of DTC businesses, and I know that your like quality of supply and kind of those relationships are all important, but if you're really, really struggling for cash, I would I would I would consider it. It's worth considering diversifying your manufacturer purely on the basis of credit terms, and because it would fix a lot of issues in the cash.
And from your experience, are most brands paying for their stock on order? Are they paying for it when it lands in the port? Are they getting credit terms at all? Are they hard to get? How do you even go about having that conversation with your supplier?
A lot of them are not getting it, which is why a lot of people are getting completely squeezed for cash. I think I would suggest that you have to just be able to sit down and have a conversation with your supplier. Okay, you're an absolute nobody of a business when you first knock on the door. You Google on Alibaba and you find some fella that's selling cups in China or wherever it might be. And that's all fine, but there has to become a point where it's a relationship and where it's a win-win relationship, and
100%.
you're back to having a conversation with manufacturers whereby your success is my success. We've been working together for a couple of years. Our sales have gone from €1,000 a month to 50 grand a month. You can see it, I can see it. Let's have a conversation here. Here's my cash flow issue. Is there any way you can facilitate me? And who knows? I think those conversations are necessary as a business matures and grows. And I think those are the conversations that's how you fix the problem, as opposed to having the conversations on the finance side. Now, again, there's a point where sales cures all ails, and if you've got 70% margin or whatever it might be on your landed cost, the sales, the margin on sales will at some point fix all this cash flow stuff. But if you find that you're in a situation, and those guys, they don't need to call their accountant because they're fine. But if you're somebody that's constantly in this kind of cash flow issue and you're finding it hard to get money, you got to do something in relation to reducing the amount of stock that you're carrying and getting credit terms. It's the only way to fix the cash flow.
If you were to hazard a guess, how many brands have had that conversation with their supplier?
I would say of the DTC, pure DTC businesses, I'd say in terms of even having the conversation, very few.
I would agree with you, by the way. But again, I think we kind of touched on the golden days of pre-COVID and even during COVID. Obviously customer acquisition costs are gone substantially up in the last couple of years. Everybody's still looking for the optimizations in the last, looking to optimize their meta account to the nth degree, whatever you want to call it. But there is a lot of operational things that you can do from a finance perspective that can aid the rest of the business as well. And I think that's, now a lot of DTC brands are only starting to wake up and realize that they can be a little bit clever around how they structure their finances. And I would agree with you. I don't think most brands are probably having that conversation with their suppliers, but I mean, it could massively improve the business as a whole and just, prevent them from getting into different holes and stuff like that, particularly from a cash flow perspective.
What I would say is what's been really interesting to watch in the last couple of years is, again, the difference between the kind of pre-COVID days where you just great conversions and so on to now. And I think what you're seeing is some of the principles of good business from
Yeah.
bricks and mortar are now pushing into e-commerce. So now we're into understanding your customer and having amazing customer service and kind of stuff that we would have all really valued if you'd walked into town in 1995 to buy a bunch of CDs or whatever it might be. Variety. So it's now in that space, and it'd be very difficult to find a B2B business in Ireland today that doesn't have credit terms from their suppliers, because it's just the way you do business. You buy from your supplier and he gives you 30 days or 45 days, and you sell to somebody else and he gives you 30 days or 45 days, and you're getting money in and you're paying money out. Whereas in this D2C environment, because most of the people have evolved from this startup space and the margin was great and sales was fixing all the ails, we're now into this reality whereby I think that conversation would be necessary. If you've got enough heft and you've got a bit of leverage and you've done good business and you've got a trading history with them, why not sign up to some kind of a supplier agreement and start having those conversations with uh, having those. It's the job of the entrepreneur to sell stakeholders in the business on the big bright future. So, for example, if you're raising money, you're standing there with your PowerPoint slide and you're saying, "Hey guys, give us the money. Tomorrow's going to be a brighter day." If you're trying to hire staff and then get people to jump on and say, "Join my marching band, and we're going to have a march over the next hill, and this is a great career opportunity." And if you're in your suppliers, it's the same conversation. It's the job of the entrepreneur to sell the stakeholders in your business of the opportunity that's presenting itself. And if you believe in it, your job is to make other people believe in it. But I just don't think people are having that conversation. Now,
Yeah.
what I would say is that at some point you have to look at your business and ask yourself the question, like, am I at a volume whereby I can start to have that conversation? And if the supplier is just not willing to have that conversation, then I'd be looking for different suppliers. And China isn't the only game in town. There's other countries that sell product and manufacture and export. And I'd be shopping around purely on the basis of trying to fix this cash conversion cycle.
Where have you found where you've seen other brands source from? Obviously, China was the main player in town for quite a long time, but I've heard of, Vietnam, Turkey popping up in the last couple of
Yeah,
years.
Portugal is popping up. Sri Lanka is another one for a long history in clothing manufacturing. I actually think I've seen a YouTube video of Gymshark moving to Sri Lanka. So there's other, yeah, Vietnam, anywhere in Southeast Asia has long histories of manufacturing. A lot of big outdoor brands, Patagonia and so on, that North Face get all their stuff made down there. So if it's the case that you're dealing with a supplier that isn't willing to buy into your future success, then Turkey's the other one. Obviously, you can shop around and see what's possible. And Romania as well. I think I've heard people building relationships as well. Partly the motivation for Romania and Turkey is you reduce the number of days in terms of the shipping, which is
Yeah.
back into your cash conversion cycle. Okay, well, maybe if we're not waiting for 30 days from point of order, maybe if we buy from Portugal or we buy from Turkey or Romania, wherever that might be, the cost might be a little bit higher, but the number of days it's going to take will reduce the cash. So again, this is stuff that people in a B2B business will be looking at and have looked at for thousands of years. But I think D2C businesses need to understand some old school business fundamentals.
Couldn't agree more. Couldn't agree more. Absolutely. No, I completely agree. Let's just say you're a brand and you do find yourself in a cash flow problem, whatever you want to call it. Historically, banks have not been very kind or willing to lend to D2C brands. And so a number of, e-commerce financiers have popped up, famously Wayflyer in Ireland, have gone on to build an incredible business. Have many of your clients worked with Wayflyer in the past or other D2C financing options?
Plenty, yeah. Grid finance is another one at the moment. Like it is what it is. Those business models are designed to provide short-term, high-risk lending. I'm not even sure if there's a personal guarantee on the Wayflyers one, but so like for short-term, high-risk lending is exactly what it is. So you're an entrepreneur. You suddenly you find you come into work on Monday morning and realize that you haven't got the money for stock, and suddenly you're onto the Wayflyer website and away you go. And okay, it serves a purpose, and they've been massively successful. I think one of Ireland's unicorns because they've put their finger on a problem, and more luck to them. I think it's expensive source of financing. I think one of the things we look at as accountants is the cost of capital in the business. So if you're borrowing at a high cost of capital and you've already got P&L issues or cash flow issues, problems are going to mount reasonably quickly. Now, it'll get you from today until 2 months down the track. The stock will be in, but if you're constantly going back to the same place, you'll have the same issues. I think it's just about. I think if it is the case that obviously the banks are unwilling to lend to what they would perceive to be high risk businesses, so startups and so on. So what I would suggest to people is that okay, if you're going to need to borrow the money, you need to borrow the money. It's as simple as that. But at what point, like, can we build a scenario here whereby we reach a sales target, whereby all these kind of issues start to resolve themselves, and through good cash flow management, through looking far enough ahead in terms of our inventory planners, what can we do to identify the bottlenecks that are going to exist in this business from a cash perspective and be so far out in front of these bottlenecks that we can start to plan accordingly. Now, you might go knocking on the doors of the banks and they might just say, listen, it's not going to happen. But if you're 3 to 6 months out in front of financing issues, then you've got a better chance of resourcing finance rather than waking up on Monday morning and realizing that you need 50 grand and suddenly you're on the way for a website. So I think that's the hole that people are digging, and sometimes the only way to fix that actually is to take a longer term view and say, well, how do we structure this business from a P&L and a cash flow perspective, and what does it look like to access finance when we need it? Um, like for example, like AIB have got have a fixed term loans, and they've got like both AIB and Bank of Ireland may lend if you approach them in time. So the whole adage is
Planning is key.
nobody like so I suppose the thing about banks is that they don't want to give you the money when you need it. So the trick is to ask them for the money when you don't need it because and the only way you can do that is by getting far enough out in front. There are other kind of maybe the Leos might have a look. They're really not that bought in on DTC brands, especially if you're importing and you're not kind of making anything in Ireland. Maybe there's Microfinance Ireland, maybe there's ways around it that you can kind of figure it out. But the first step is you got to get out in front of it by about 3 to 6 months, understand where the cash flow issue is going to happen, and plan accordingly.
Is there a time and a place for it? Obviously, there's instances where you just haven't planned far out in front and you do need the cash. If you are scaling profitably and you just want to take a bigger bet in yourself and the bank isn't willing to give you the cash, is there a place for revenue-based financiers to kind of fuel that growth, I suppose? Like they have tons of really, really good case studies on there as well.
Oh, 100%. As in, I'm not against revenue-based lenders at all. I think they've fueled a lot of the growth in the e-commerce space. I suppose what I'm driving at here is to be completely reliant on revenue-based. I suppose the point I'm making here is that you should consider your cost of capital and ask yourself the
Yeah.
question, at this price, does this lending make sense with the growth that we're trying to achieve? And I would suggest that at some point, maybe the cost of capital could be substituted for something which is a little bit less pricey. For example, okay, you're in this startup mode and you need access to capital and you need it quick and easy and so on, and that's fine. But like at Bank of Ireland, they're lending at 5.65% at the moment.
That's very good.
Like Wayflyer are going to cost you a lot more than that. It depends on how much the repayment's going to be and so on, but it's going to be up towards the 10% mark. So all I would suggest is that yes, there's a place for them. Yes, they're great. And if you're making plenty of money, sometimes it's just so easy to get the loan, and engaging the banks can be a pain in
Yeah.
the backside. But I would just look at that cost of capital a bit and say, is the cost of capital that we're accessing right now sufficient to achieve where we want to go in the next 6 months, 12 months, maybe 2 years?
Yeah, 100%. You don't want to fall into that kind of endless loop of continuously getting more and more capital and getting the daily remittances out because it'll just unfortunately kill your cash flow coming
Kill your
in.
cash flow and you're back around to where you started. So I just say that it's a little bit pricey. It serves a purpose, and hopefully it could fuel your growth to get to a point where maybe we look at substituting out that as a source of financing to something that's a bit less expensive. If it's lending, traditional banks are going to lend at a lower rate, and if it's not lending, then you're looking to raise funding through whatever way you want to raise funding, financing, investment, different ways of doing it.
Richie, this is going to go out the end of September here. We're just about to jump into October, November, and obviously December. Three of the busiest months of the year. The majority of e-commerce brands we're dealing with will do anywhere from 30 to 45% of their entire revenue. Even within that 3 month period, it's probably a condensed 6 week window where the
Yeah,
majority
yeah.
of the action is going to happen. How do you think about like marketing spend and even forecasting for DTC brands? It can be scary for brands. A lot of brands are simply just setting revenue targets without setting EBITDA or profit targets underneath. And coming towards the end of the year, if we're missing on revenue targets, I see this all the time. Brands will often look to overcompensate on things like discounts and ad spend in order to hit that kind of overarching revenue target. They might get there, but they might suck all the margin that the business was actually established for in the first place out of the business. How do you think about, I suppose, just, the condensement of the shopping window for e-commerce brands who are heavily reliant on such a small window to kind of almost make the year for them as a whole?
It's yeah, I would expect a lot of our e-commerce clients to do, I suppose, average of 35%, maybe 40% of the annual revenue from uh, Black Friday onwards, probably until the post won't get there on time, which is a couple of the international one is probably 5 days before Christmas or whatever. So it's within that window that you'll make your almost a significant portion of your annual revenue. And there's good and bad in that. There's good because if you've managed to break even for the year, you're going to make your money. You'll have cash in the bank coming towards the year end, and away we go again. There's a few things to say on that. If you're making a lot of revenue in Q4, it means you didn't make as much in Q1, Q2, and Q3. So are you carrying problems into Q4 that you're hoping Q4 to fix? It does Q4 just fix the problems, and then you're looking forward to like Q1 to Q3 next year, and you're wondering, well, what are we going to do about it? Key things I would say to people is, if possible, you want to carry some kind of a cash buffer always inside in your business. Rule of thumb, if you're carrying somewhere between 2 to 4 months cash on hand, it's a healthy business. And for example, in other businesses that are not just direct to consumer businesses, we'd be looking at moving some of that cash into pensions and doing different things before we come towards the year end. But I would suggest, and it's unfortunately the reality, is that whilst we're looking at Q4 and you as marketeers are trying to hit revenue, and Q4 almost takes care of itself. Where I'm looking at is Q1 and Q2 next year, and asking ourselves the question, well, how much cash do we need to carry? What money do we need for stock in the new year? And just those types of runway issues that I would be looking to see. Well, what are we looking to achieve in Q4? Does it fix problems from Q1, Q2, and Q3? And what position are we going to be in for Q1 and Q2 next year? And if it's the case, do we need access to financing? So, for example, going back to what we just said, if there's plenty of money in the bank account in November, maybe we knock on the door of one of the banks and push the overdraft that might get us through Q1 and Q2 next year. So again, not to be asking for cash when you need it is the number one trick when you're trying to solve those problems. But yeah, I think for most businesses they are looking for a healthy Q. If you are in a position whereby you're lucky enough to have a good Q4 and you're carrying a bit of cash on hand, I'd be looking towards the year end, asking yourself the question, well, how much cash do we need to carry? You want a little bit of a buffer, somewhere like 2 to 4 months fixed operating costs is usually good. And then just ask yourself the question, the lumpiness of inventory can kind of change that a little bit. And then the rest of it, you're starting to do tax mitigation things. So if you're landing the year with a healthy profit, to reach out to your accountant, I think, before the close of business at the 31st of December at the year end. And ideally, what you want to do is ask yourself the question, how much cash or profit do I want to carry in the bank account? And how much do I want to do other things with it to try and reduce the CT bill? And I think that's kind of a year-end accountant's tax planning bit that we would do with a lot of clients, probably in week 1 of November or week 4. 1 of December, sorry, is probably the time right in the middle when most of the DTC brands are really, really busy. If there's plenty of profit there, we want to do something about that before we get to the year end.
Absolutely. How do you think about brands simply optimizing for revenue? And I mean, like often leading to perverse incentives for e-commerce managers or agencies where, they look at other avenues to make that revenue happen that isn't necessarily within the brand's best interests.
Yeah, I think that's been the number one issue that we've seen in the last number of years. I think you need to optimize business for profitability. I think what we've seen with a lot of businesses who are chasing revenue was just like their costs were increasing. They're still trying to chase revenue. There's less profit in the business. Where really what you're trying to do is scale up and scale down as revenue. You almost want to think there's like a structure to your business whereby as sales go up, your costs can go up, your fixed costs should stay relatively flat, and you're trying to manage that up and down, and you're trying to manage the journey of the business from a cash flow and a P&L perspective. But if you're only chasing revenue, it just leads to bad decisions. It leads to running out. It leads to being unprofitable. So I think getting to know you guys a little bit in the last year or so, probably a little bit more, is that you optimize for contribution margin, you optimize for profit. I think that going back to what I said earlier on, is I think every DTC or every entrepreneur should break your business up into quarters. You should have an understanding of whether you're profitable month by month, and ask yourself the question, can the business handle not being profitable if that's the case? And if there is a profit target, then what should it be? Being honest, it's very hard to grow and be super profitable at the same time. The only exception really is probably software businesses or something like that. But it's very hard for most product-led businesses to be both profitable and grow at the same time. But I would suggest that at least targeting break even, maybe plus 10% net profit, because that'll handle some of the cash flow issues, would be a good place to land the year end.
Richie, if people are looking to get in contact with you, where can they find you?
I'm online. We've got a reasonable presence at the moment. Aroundfinance.ie is the website. You can find me on LinkedIn. It's Richie Lennon. Feel free to reach out either way, and I'm always available for a chat to anybody that just wants to have a conversation about their business. Yeah, just feel free to reach out.
Brilliant. We'll drop a link to the website, your LinkedIn, and your email in the show notes here as well. But for myself, Richie, thank you very, very much for coming on. Really, really appreciate that. And I got loads out of that conversation.
Thank you so much, Thomas, and I'll meet you walking the prom offline at some stage, surely, on these sunny evenings.
Absolutely.
Take care. Good luck.
Thanks.
Bye.